Let me ask you something that might keep you up at night. What if everything you've been told about retirement planning is about to become obsolete? I'm not talking about market corrections or bear markets. I'm talking about something far more fundamental. Something that could make the difference between a comfortable retirement and watching your purchasing power evaporate in real time. Right now, as you're watching this, there's a quiet revolution happening in the financial world. Central banks across the globe are making moves that haven't been seen since the 1970s. And if you're planning retirement, or already in it, what they're doing should be sending alarm bells ringing in your head. Because here's what nobody's telling you. The very foundation of retirement planning, the 60-40 portfolio, the bond ladder, the dividend stocks, all of it was built for a world that no longer exists. Let me show you what I mean. In 2023, central banks purchased over 1,000 metric tons of gold. That's the second highest annual purchase on record. But here's where it gets interesting. In the first half of 2024, they accelerated. They bought another 483 tons in just 6 months. The People's Bank of China alone added to their reserves for 18 consecutive months. Now, why would central banks, the very institutions that print money, be stockpiling gold at a pace we haven't seen in decades? Think about that for a second. These are the people with access to unlimited currency. They can create dollars, euros, yuan with a keystroke. Yet they're converting those digital entries into physical metal and storing it in vaults. What do they know that you don't? I'll tell you exactly what they know. They understand that we're living through the largest monetary experiment in human history, and they're hedging their bets. Since 2008, global central banks have created over $25 trillion in new money. That's not an exaggeration. 25 trillion. And that money didn't just disappear into the ether. It's sitting in the system, waiting. Now, if you're in your 50s or 60s, you remember what inflation felt like in the late 1970s and early 1980s. You remember when Paul Volcker had to raise interest rates to nearly 20% just to kill it. But here's what's different this time. Back then, the U.S. national debt was under $1 trillion. Today, it's over 36 trillion. Back then, we could afford to raise rates that high. Today, every percentage point increase adds hundreds of billions to our interest payments. We're trapped, and central banks know it. Let me paint you a picture of what's happening right now in the gold market, because this is where it gets fascinating. There are essentially two gold markets operating simultaneously. There's the paper market, where banks and institutions trade contracts representing gold, and there's the physical market, where actual metal changes hands. For years, these two markets moved in lockstep, but something changed in 2022. The physical market started diverging from the paper market. In Asia, gold was trading at premiums of $50 to $100 per ounce above the London spot price. That's unprecedented. It means there's such strong demand for physical metal that buyers are willing to pay significantly more than the official price just to get their hands on it. Why? Because they don't trust the paper promises anymore. Here's a story that illustrates this perfectly. In March 2023, a major European bank needed to deliver physical gold to settle a contract. Sounds simple, right? Except they couldn't find the metal. They had the paper contracts. They had the electronic ledger entries. But when it came time to deliver actual gold bars, they had to scramble across 3 continents to source enough metal to fulfill their obligation. The premium they paid? Over $80 per ounce above spot. That's not supposed to happen in a functioning market. That's a sign of stress. That's a sign that the paper market has created claims on far more gold than actually exists in available form. Now let's talk about what this means for your retirement. If you're like most Americans, your retirement savings are probably sitting in a mix of stocks and bonds. Maybe you've got a 401k, an IRA, some mutual funds. You've been told to diversify, to stay the course, to think long-term. But here's the problem. All of those assets are denominated in dollars. Every single one. Your stocks are priced in dollars. Your bonds pay interest in dollars. Your mutual funds are valued in dollars. You're not diversified. You're concentrated in a single currency that's being systematically devalued. Let me give you some numbers that should terrify you. In 1971, when Nixon closed the gold window, an ounce of gold cost $35. Today, it's over $2,600. That's not because gold became more valuable. It's because the dollar became less valuable. Gold didn't go up. The dollar went down. But here's what really matters for retirees. In 1971, the average Social Security benefit was about $133 per month. Today, It's around $1,900. Sounds like a huge increase, right? Except in 1971, that $133 could buy you 3.8 ounces of gold. Today, that $1,900 buys you less than 1 ounce. Your purchasing power, measured in real terms, has been cut by 75%. That's the hidden tax of inflation. And it's accelerating. Now, I want to show you something that most financial advisors won't tell you, because frankly, it doesn't fit their narrative. Let's look at what happened to retirees during the last major inflationary period. In 1970, if you retired with $1 million, you were wealthy. You could live comfortably on the interest from bonds, which were yielding 7 to 8%. That's $70,000 to $80,000 a year, which was excellent money back then. But then inflation hit. By 1980, that $1 million had lost over 60% of its purchasing power. Your $70,000 annual income could now buy what $28,000 bought in 1970. Meanwhile, your expenses had more than doubled. Food, energy, healthcare, everything cost more. Much more. Retirees who had their wealth in bonds got destroyed. The value of their bonds collapsed as interest rates rose. The income from those bonds couldn't keep pace with inflation. They were forced to sell assets at depressed prices just to maintain their lifestyle. But here's the other side of that story. Retirees who had allocated even 10 to 20% of their portfolio to gold did something remarkable. They preserved their purchasing power. While their bond portfolio was getting hammered, their gold position was rising from $35 an ounce to over $800 by 1980. That's a 2,200% increase. It didn't just keep pace with inflation, it crushed it. Now, I'm not saying we're going to see $800 gold again. We're already past that. But I am saying that the same dynamics are in play. We have massive debt, we have money printing, we have negative real interest rates, and we have central banks that are trapped. And here's the kicker. It's actually worse this time. Because in 1980, we could raise rates to kill inflation. Today, we can't. The debt burden is too large. The financial system is too leveraged. If we raised rates to 15 or 20% like Volcker did, the entire system would collapse. The government couldn't afford the interest payments. Corporations couldn't refinance their debt. The housing market would implode. So what's the alternative? They're going to try to inflate their way out. They're going to keep rates lower than inflation, which means negative real rates, which means your savings are losing purchasing power every single day. Quick aside here, because this is important. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without triggering tax penalties. Worth checking out if that's relevant to your situation. Anyway, back to what's happening in the market right now, because this is where it gets really interesting. There's a concept in the gold market called the gold to silver ratio. Historically, it's averaged around 60 to 1. That means it takes 60 ounces of silver to buy 1 ounce of gold. Right now, that ratio is around 85 to 1. That's telling us something important. It's telling us that silver is undervalued relative to gold, which means there's potential for significant catch-up. But more importantly, it's telling us that industrial demand for silver is about to explode. Because silver isn't just a monetary metal. It's used in solar panels, electric vehicles, 5G infrastructure, medical devices. The green energy transition alone is going to require billions of ounces of silver over the next decade. And here's the problem. We're not mining enough to meet that demand. Global silver production has been essentially flat for years, while demand keeps growing. That's a recipe for a supply squeeze. And when supply squeezes happen in precious metals, prices don't just rise, they explode. Let me give you a historical example. In 2010, silver was trading around $18 an ounce. By April 2011, it hit $49. That's a 172% increase in less than a year. What caused it? A combination of investment demand and industrial demand colliding with limited supply. Now, imagine what happens when the green energy transition really kicks into high gear. When every new solar installation requires silver, when every electric vehicle requires silver, when every 5G tower requires silver, and there's not enough production to meet that demand. The price doesn't just go up, it goes parabolic. But let's get back to gold, because there's something happening right now that's absolutely critical for retirees to understand. The BRICS nations, that's Brazil, Russia, India, China, and South Africa, plus about 40 other countries that are now joining or considering joining, are actively working to create an alternative to the dollar-based financial system. And at the center of that alternative system is gold. Now you might think, so what? The dollar is the reserve currency. It's been the reserve currency since World War II. Nothing's going to change that. Except things are already changing. In 2000, the dollar accounted for 71% of global foreign exchange reserves. Today, it's down to 58%. That might not sound like a big deal, but that's a massive shift in just 2 decades. And it's accelerating. China and Russia are settling trade in yuan and rubles, bypassing the dollar entirely. Saudi Arabia is now accepting yuan for oil sales. The UAE is building gold refineries to facilitate gold-backed trade settlement. India is buying Russian oil with rupees and gold. This is de-dollarization in real time. And every step away from the dollar is a step toward gold. Here's why this matters for your retirement. If the dollar loses its reserve currency status, even partially, the implications are staggering. It means less demand for dollars. Less demand for dollars means less demand for dollar-denominated assets. That's your stocks, your bonds, your money market funds, everything. But it also means more demand for alternatives. And the primary alternative, the one that's been money for 5,000 years, is gold. Now, let me show you something that most people don't understand about gold. It's not an investment. It's insurance. It's a hedge against the failure of the monetary system. And right now, that insurance is incredibly cheap relative to the risk. Think about it this way. If you own a home worth $500,000, you probably pay $1,500 to $2,000 a year for homeowners insurance. That's about 0.4% of the home's value. You do that because you want protection against catastrophic loss, even though the odds of your house burning down are very low. Now, what's the odds of the monetary system experiencing significant stress over the next 10 to 20 years? Given the debt levels, the money printing, the geopolitical tensions, the de-dollarization trend, I'd say the odds are considerably higher than your house burning down. So why wouldn't you allocate 10 to 20% of your retirement portfolio to gold as insurance against that risk? Especially when that insurance has historically not just preserved wealth, but increased it during times of monetary stress. Let me give you another historical example that's particularly relevant for retirees. In 2008, during the financial crisis, the stock market collapsed. The S&P 500 fell 57% from peak to trough. If you were retired and living off your portfolio, that was devastating. You were forced to sell stocks at depressed prices to generate income, locking in losses and permanently impairing your retirement. But gold? Gold went from $800 an ounce in 2008 to $1,900 by 2011. While stocks were collapsing, gold was rising. It provided exactly the kind of protection retirees needed. Now here's what's different today. In 2008, central banks could cut rates to zero and print money to stabilize the system. And it worked, eventually. But they never normalized. They never raised rates back to historical levels. They never reduced their balance sheets back to pre-crisis levels. So when the next crisis hits, and it will, they're starting from a position of already having rates near zero and balance sheets that are already bloated. They've already used their ammunition. What are they going to do? Go to negative rates? Print even more money? Both of those options are incredibly bullish for gold. Let me tell you about something called the Cantillon effect, because this is crucial for understanding what's happening to your retirement savings. When central banks create new money, that money doesn't enter the economy evenly. It goes to certain people and institutions first. Banks, large corporations, wealthy individuals. They get access to that new money before prices rise. By the time that money trickles down to regular people, to retirees living on fixed incomes, prices have already increased. You're getting the inflation without getting the benefit of the new money first. You're on the wrong side of the Cantillon effect. But gold? Gold benefits from the money creation directly. As the money supply expands, gold's price rises to reflect that expansion. It's on the right side of the Cantillon effect. This is why central banks own gold. This is why billionaires own gold. This is why sovereign wealth funds own gold. They understand that in a world of unlimited money printing, you need an asset that can't be printed, an asset with a fixed supply, an asset that's been recognized as money for thousands of years. Now, let's talk about what's coming next, because this is where it gets really important for anyone planning retirement. We're entering a period of what economists call financial repression. That's when governments keep interest rates below the rate of inflation, forcing savers to lose purchasing power. They do this to inflate away their debt burden. It's a hidden tax on savers and retirees, and it's already happening. Real interest rates, that's the interest rate minus inflation, have been negative for most of the past 3 years. If you're holding cash or bonds, you're losing purchasing power every single day. But here's the thing about financial repression. It creates a massive incentive to move money out of cash and bonds and into real assets. Assets that can't be inflated away. Assets like real estate, commodities, and precious metals. We're already seeing this play out. Real estate prices have surged, commodity prices have surged. And gold? Gold has been quietly making new all-time highs, even as most people aren't paying attention. The smart money is already moving. The question is, are you? Let me give you a specific scenario to think about. Let's say you're 60 years old, planning to retire in 5 years. You've got $800,000 in your 401k, mostly in a target date fund that's 60% stocks, 40% bonds. You're feeling pretty good. The market's been strong. Your balance has been growing. But what if we get a repeat of the 1970s? What if inflation stays elevated for years? What if your bond allocation gets crushed as rates rise? What if your stock allocation stagnates in a stagflationary environment? By the time you retire, that $800,000 might still be $800,000 nominally. But in real terms, in purchasing power, it might be worth $500,000 or less. Your retirement just got cut by 40%, and you didn't even realize it was happening. Now, same scenario, but you allocated 15% to gold. That's $120,000. If gold performs like it did in the 1970s, rising 2,000%, that $120,000 becomes $2.4 million. Even if it only rises 500%, that's $600,000. Your gold allocation alone could make up for the purchasing power loss in the rest of your portfolio. That's the power of asymmetric risk. Your downside is limited. Gold might go down 20 or 30% in a deflationary crash. But your upside? Your upside is potentially unlimited in an inflationary or currency crisis scenario. And here's the beautiful thing about gold. It's liquid. You can sell at any time. It's recognized globally. It has no counterparty risk. It doesn't depend on a company's earnings or a government's promises. It just is. Now, I want to address something that financial advisors often say about gold. They'll tell you it doesn't produce income. It doesn't pay dividends or interest. And that's true. But that's also missing the point entirely. Gold isn't supposed to produce income. It's supposed to preserve purchasing power. It's supposed to protect you when everything else is failing. And in that role, it's unmatched. Think about it this way. In 1971, the average home in America cost about $25,000. At $35 per ounce, that's about 714 ounces of gold. Today, the average home costs about $420,000. At $2,600 per ounce, that's about 162 ounces of gold. So in dollar terms, homes got more expensive. But in gold terms, they got cheaper. Gold preserved purchasing power. The dollar didn't. That's what gold does. It maintains your ability to buy real things: food, energy, housing, healthcare, the things that actually matter in retirement. And here's something else most people don't realize. Gold has actually outperformed the stock market over the past 25 years when you account for inflation. From 2000 to 2025, gold is up over 700%. The S&P 500 is up about 400%. And that's before accounting for inflation, which has eroded about 60% of the dollar's purchasing power during that time. So when someone tells you gold is a bad investment because it doesn't produce income, ask them this. Would you rather have an asset that produces 2% income but loses 5% purchasing power per year, or an asset that produces no income but gains 10% purchasing power per year? The answer should be obvious. Now, let's talk about timing, because I know what you're thinking. Gold is already at all-time highs. Isn't it too late to buy? Here's the thing about gold. It's not about timing the market. It's about protecting yourself from monetary debasement. And that debasement is ongoing. It's not stopping. If anything, it's accelerating. But if you want to talk about timing, let me give you some perspective. In 1980, gold hit $850 an ounce. Adjusted for inflation, that's over $3,200 in today's money. We're not even at the inflation-adjusted high from 44 years ago. And the monetary situation today is far worse than it was in 1980. The debt is higher. The money printing is more extreme. The geopolitical tensions are greater. The de-dollarization trend is accelerating. If gold simply returns to its inflation-adjusted 1980 high, that's another 25% upside from current levels. And if we get a real monetary crisis? If we get hyperinflation or a currency collapse, gold could go far, far higher. But here's what I want you to understand. This isn't about getting rich. This is about not getting poor. This is about making sure that the retirement you've worked 30 or 40 years to build doesn't evaporate because of monetary policy decisions made by people who don't care about your retirement. Because that's what's at stake here. Your financial security, your ability to live comfortably in retirement, your legacy for your children and grandchildren. And the people making these decisions, the central bankers, the politicians, they're not going to protect you. They're going to protect the system. They're going to protect the banks. They're going to protect the government's ability to finance its debt. You have to protect yourself. And the way you do that is by owning assets that can't be printed, can't be debased, and can't be inflated away. Assets that have maintained their value for thousands of years through every empire, every currency, every financial system that's ever existed. Gold is that asset. It's survived the fall of Rome. It's survived the collapse of the British pound as the reserve currency. It's survived the Weimar hyperinflation. It's survived every financial crisis in modern history, and it will survive whatever comes next. So if you're planning retirement, if you're worried about inflation, if you're concerned about the direction of monetary policy, if you're looking at the debt levels and the money printing and thinking something doesn't add up, you're right. Something doesn't add up. And the people who understand that, the central banks, the sovereign wealth funds, the billionaires, they're buying gold. They're protecting themselves. The question is, will you?